welcome back to another episode of Scott's Quick Cash Class. Today we're going to be talking about interest rates and do we know what to do with them, right? So why does your bank hope you stay dumb about interest rates? So the average credit card interest rate is 24%. Now I know a lot of you guys are out there saying, Scott, I got 0%, or hey, I got an introductory rate of 6%, or hey, my credit's great, I got 10%. Good for you. This isn't for you. There might be some things that you could pick up from it, but if you got low credit card interest and you're doing just fine, then keep plugging along and this isn't for you. But for those of you that do have really high interest rates, and 24 is the average, realistically, there's a lot of cards out there that are 29 and maybe even higher. And if you have some cards that maybe are from some secondary banks, not like a Chase or a Wells Fargo, they might even have higher interest rates. So I know on mine, if I carry a balance, it's 19%. Fortunately, knock on wood, it took me a long time, but I'm at 800 credit score. So I've managed that part very well. That I have not, obviously I've paid a lot of interest in my lifetime when I was younger, but I've learned to manage that so that I don't carry balances on there. So let's talk about a few things, right? Why is interest, why is that, why is it important? They talk about it, on TV all the time. They talk about it when you go to buy a house. They talk about it with your cars. And essentially, here's how interest rates are determined. There's a few different factors, but basically you have the federal bank, the Fed, and they are the ones that essentially set the baseline for interest rates. What they do is, you have this guy, his name's Jerome Powell right now. President Trump is not very happy with him. That's a whole nother conversation. But you have a Fed chair. He gets together with his peeps. They decide on the economy based on how the economy is, how the unemployment is. Should they raise interest rates or lower interest rates? And what that actually does is they are raising or lowering the rate in which they loan money to regular banks that we borrow off of. So if regular banks' interest rates go up, they ain't gonna eat that cost. They're gonna pass that on to us, and it's verbatim. If the Fed raises it a half a point, generally speaking, your regular bank is gonna go up half a point. So all interest rates are based off the Fed as a baseline. And then you get into your credit scores, right? The better credit scores you have, the lower your interest rate's gonna be. And then it also depends on what product you're buying. Something like a house, you're gonna get the best interest rate that you probably can versus anything else because the house is not moving anywhere. It's an asset. Generally, they appreciate in value over time. So the bank looks at that as a pretty safe investment. Cars, they depreciate, but banks look at them a little bit safer investment. Credit cards are what they call unsecured debt, meaning there's really not recourse for the credit card company. If you went out and charged a vacation for $5,000, which I know of some friends that have done this, and then they just don't pay their credit card bill and they let it go into collection. Not very smart. Don't recommend it. They've had to work to get back to good credit because of that. It took them a long time, but essentially the credit card companies, they have to charge that high of interest, especially when you're a new or a relatively moderate credit score. They have to charge those types of interest in order to be profitable and cover themselves. Now, how do we get around that? Well, we looked for ways for us to get interest. And so I'm going to give you a little piece of information that changed the way I thought about money since I've been 18. And I'm going to be 45. So for 27 years, this rule changed the way I thought about money. And it's called the Rule of 72. And that is whatever interest rate you're getting, you divide that in to 72. So let's say you're getting 8% interest. If you divide 8 into 72, you get 9. Every 9 years, your money doubles. So if you get 8% interest and you have $10,000, in 9 years, you're gonna have $20,000. In another 9 years, you'll have $40,000, so on and so forth. Well, that rule works with credit card interest or other interest. So if your interest is 24%, every 3 years, your balance is gonna double, right? So if you have a $1,000 balance and you're just making minimum payments on that, in 3 years, that payment or that amount could double. So just to give you an idea, if you have a $1,000 balance, that's $240 worth of interest in a year. If you divide that out, that's $20 a month on that $1,000 you spent. That's just going towards interest to the credit card. You're not even paying off any of the principal. So keep that in mind the next time you go out there and make a purchase, or when you're looking at opening a credit card, look and see what the interest rate is. So I'm gonna leave you with tip of the day and question of the day is question of the day is, when was the last time you negotiated for a better interest rate? And that could be with the bank, that could be with a car dealership, that could be with a credit card, a lot of different people. I mean, I negotiate all the time about everything. So this really, this is one that I just get used to negotiating. It'll save you thousands of dollars over your lifetime. So think about that. And then tip of the day, interest works for you or against you, not both. So which one is it doing for you right now? If you can get it working for you, money makes money. Remember that. Get it working for you. Till next time, leave us a question, leave us a comment. If you like what you heard, subscribe. Every day we're bringing you 5 to 7 minute videos helping you with your different finances. Yeah, till next time.